Okay, let's unpack this alphabet. It's a name that, well, it resonates throughout the modern digital world, doesn't it? A true giant.
Absolutely. And it brought us Google, of course, but also this whole array of other ambitious projects.
And that's precisely what we're diving into today. Not just skimming the surface, but really undertaking a deep exploration. We've got this comprehensive long-term investment research report on Alphabet Inc., ticker GOUGL.
Right. And what's really interesting here, our goal for you, the listener, you want to gain a solid understanding, but efficiently, right?
Exactly. Time is valuable.
So we're extracting the critical insights from this pretty dense analysis. Think of this as your streamlined path to understanding the core drivers behind Alphabet's long-term potential and, its strategic direction.
Yeah, we're cutting through the noise. Consider us your informed guide, sort of pinpointing the crucial data, maybe some surprising details you need to grasp the big picture.
And we'll be covering quite a bit of ground.
We will. The foundational history, the leadership that shaped Alphabet, then the powerful engines, those core businesses.
Search, YouTube.
Right. And the fascinating, sometimes audacious innovation frontiers, those famous moonshots.
Yeah, the really out there stuff, plus the competitive landscape, which is fierce.
Fierce is the word. And the complex geopolitical factors at play, and naturally how this all, shakes out in its financial performance.
If you step back for a moment, you see this company operating with just incredible reach, incredible influence.
Undeniably.
Yet at the same time, it faces constant evolution, significant challenges too. Our aim here is really to illuminate this dynamic for you.
To clarify the forces at work.
Exactly, and ultimately provide a clear perspective on Alphabet's trajectory, where it might be heading.
So where did this all be? Let's journey back to the start. Google. It emerged from the work of two Stanford PhD students, Larry Page and Sergey Brin, back in 1998.
Right, and here's a fun fact initially called backrub.
Backrub. Doesn't quite have the same ring to it, does it?
Not really, but interestingly, even with that, let's say, unusual name, the fundamental innovation was already there, PageRank.
Ah, yes, the algorithm.
That original method for assessing web page relevance by looking at links, that was the catalyst, that was the secret sauce right from the beginning.
And their ambitions, even then, were far from modest. Their early ethos, you can see it clearly articulated in their 2004 IPO letter.
Oh yeah, that letter's famous.
It emphasized commitment to long-term innovation, earning user trust. They famously stated, "Google is not a conventional company. We do not intend to become one."
That's a statement that really set them apart, didn't it? It truly established a guiding principle.
And their mission, to organize the world's information and make it universally accessible and useful. It wasn't just a slogan, was it?
No, not at all. It became the central tenet guiding their decisions, even when those decisions involved, significant risk in the short term.
The subsequent rise was just remarkable. Dominance in search, then that hugely successful IPO in 2004 generated what, $1.67 billion?
That's right. And that capital, it fueled their expansion into services we now just take for granted. Gmail, Maps, News.
Staples of the internet. And it wasn't solely focused on refining search, was it? The founders were always keen on pursuing those risky projects that might result in home runs.
Yes, that early and enduring commitment to those potential home run ventures is really key. Key to understanding the structure and strategy of Alphabet today.
They weren't content with just dominating search.
No, they were already thinking way beyond that, about the next transformative technologies.
Which brings us neatly to 2015, a pivotal moment. Google undergoes this significant restructuring, becomes Alphabet Inc. What was the thinking there? Why the big shift?
The rationale was deeply strategic. It allowed the core Google businesses, the main moneymakers, to maintain focus.
Keep the engine running smoothly.
Exactly. While simultaneously granting autonomy and, crucially, imposing greater financial accountability on those other bets, the more experimental stuff.
Right, the moonshots we mentioned.
As Larry Page put it, Alphabet was designed for more clarity, better oversight.
So Page became CEO of the parent company, Alphabet, and Sundar Pichai stepped up as CEO of Google.
A clear division of labor.
Seems logical.
Precisely. And then in 2019, another significant evolution. Page and Brin stepped back from day-to-day management entirely.
Right, they used that analogy.
Yeah.
Comparing Google to a young adult leaving home.
It's a compelling analogy, isn't it? Suggests the core Google business had reached a certain maturity, could operate independently.
But even stepping back from active management, their foundational influence must still be huge, right? They weren't just founders. They really shaped the whole culture.
Absolutely. Instrumental in establishing those core values. Relentless user focus, dedication to technical excellence, and that well-known, sometimes debated principle.
Don't be evil.
Don't be evil, yeah.
Yeah.
That commitment to ethical considerations, at least initially, profoundly influenced things, product development, public perception.
And we can't overlook some of those early, maybe seemingly unconventional bets that turned out to be transformative. YouTube in 2006, Android in 2005. Some people were skeptical at the time.
Oh, definitely. As Page himself noted, many thought those moves were quite unconventional.
But they became dominant global platforms.
It highlights the remarkable ability, doesn't it, to see long-term potential where others just didn't.
And even today.
Even today, as the largest shareholders and board members, Page and Brin still wield considerable influence, ensuring that long-term thinking stays central to Alphabet's approach.
So Pichai takes the reins at Google. What's his story? What's his vision been for this evolving tech giant?
Pichai, strong engineering background, MBA too. He rose through the ranks, leading key products like Chrome, Android.
Right, products we all use.
His overarching vision, transitioning Google into an AI-first company, deeply integrating artificial intelligence across pretty much everything they do.
And it seems he's had to navigate that carefully.
Yeah.
Balancing the push for innovation with, responsibility.
That's a crucial point. He's often spoken about needing a bold and responsible approach to AI, acknowledging the immense potential, but also the critical need for thoughtful, ethical implementation.
The restructuring that formed Google DeepMind highlights that focus on AI, doesn't it?
Yeah. Absolutely. It underscores AI's central importance across the entire Alphabet ecosystem.
We've also seen some moves towards maybe greater financial discipline under his leadership. The workforce reductions in 2023, for example.
Yes, those cost controls, they were a response to shifting macroeconomic conditions, but also a strategic move towards greater operational efficiency.
Shows a willingness to make tough calls.
It does, to safeguard the company's long-term financial health, its sustainability.
And what about the broader governance structure at Alphabet? Who else is key in steering the ship?
Well, you have John Hennessy as chairman, a highly respected figure in tech and academia, and Ruth Porat as president and CIO. She's really brought a strong focus on financial rigor, strategic resource allocation.
And the share structure, that dual-class system.
Yes, that's noteworthy. It does limit the voting power of many shareholders, that's true, but arguably it gives leadership the latitude to pursue that long-term vision we've been discussing.
Without being swayed too much by short-term market pressures.
That seems to be the idea. It supports a leadership team that can prioritize long-term growth, innovation, without being constantly beholden to quarterly earnings expectations.
So while it raises questions for some about shareholder influence,
it also appears to be a mechanism that's enabled those ambitious, sometimes unconventional, long-term plays.
and the core values communication.
Still central. User focus, tech transparency, bold innovation. These themes remain consistent in their messaging.
It all paints this picture then. A leadership cultivating innovation, long-range thinking, but also balancing it with necessary financial prudence.
I think that's a fair assessment.
Okay, foundation established. Now, let's get into the engine room. The core of Alphabet, the main products, the business lines under Google services.
Right. This segment is the primary driver of revenue and profit. Think of it as the incredibly efficient engine that fuels everything else, including those speculative ventures we'll get to.
And it's a vast portfolio. Search, ads, YouTube, Android, Cloud, Play Store, Pixel, Nest. It's extensive. The report breaks it down. Google Services is the lion's share, right? Something like 89% of total revenue in 2023.
That's the number. And within Google Services, search and advertising is the undisputed powerhouse. Near monopoly in global search, around 90% market share.
90%. It's the primary gateway to information for billions.
And that dominance translates directly into an exceptionally lucrative ad business. Those keyword-driven text ads alongside results.
Because advertisers reach people actively looking for their stuff. High intent.
Exactly. And the scale is just immense. In 2023, revenue from Google Search and other ads hit $175 billion. That's up a solid 8% year over year.
What's driving that growth?
Several things. Continued rise of mobile searches, better ad formats, increased advertiser spending. They've also seen growth in paid clicks, with costs per click staying relatively stable.
But it's not all pure profit. Those traffic acquisition costs tack. The big payment to Apple, reportedly around $15 billion a year, to stay the default on iPhones. That's a huge chunk.
Absolutely. TAC is a necessary cost of doing business, securing prominent placement on browsers, devices, ensuring user access. Across Google's network, TAC was nearly $60 billion in 2024.
Wow.
But even after that, the gross margins on search are exceptionally high. Highly scalable infrastructure, not much competition at their scale.
Okay, next up, YouTube, the video behemoth. Acquired way back in '06, it's become a cultural phenomenon, hasn't it? And a core part of the ecosystem.
Definitely. Over 2 billion logged-in users every month. It's the largest online video platform by a mile. Revenue mostly from ads, but subscriptions are growing notably too.
Ad revenue in 2023.
$31.5 billion. Another healthy 8% year-over-year increase.
And advertisers love it for the reach, the demographics.
Yeah.
Especially younger audiences drifting from traditional TV. But it's faced challenges, hasn't it? TikTok, short-form video.
Oh yeah. The rise of TikTok, that short-form video explosion, it definitely put some pressure on YouTube's growth.
Their response was Shorts.
Right, YouTube Shorts, which has gained significant traction pretty quickly. Now, initially, the monetization rates for Shorts were lower than traditional YouTube videos.
Made sense, different format.
But we're now seeing an acceleration in the ad business there. New formats, more innovation, and YouTube is still the leader in overall streaming watch time and in podcasting too.
And that combined run rate with cloud.
By end of 2024, YouTube plus Google Cloud hit an impressive $110 billion annual revenue run rate, shows its continued strength.
Plus, they're diversifying beyond ads. Premium, music, TV subscriptions. Those are growing.
Showing promising growth, yes. And don't forget live sports, the NFL Sunday ticket deal.
Right, big investment there.
Exactly. This revenue from subscriptions, platforms, and devices hit $11.6 billion in Q4 2024 alone. Shows real momentum. Still smaller than ads, sure, but it's a substantial, rapidly expanding stream.
Profitability compared to search.
Margins are somewhat lower, mainly because they share 55% of ad revenue with creators.
That's a big payout.
It is. Plus, ongoing challenges, costs related to content moderation, regulatory scrutiny that takes resources. But the long-term potential, still substantial, especially internationally, and integrating e-commerce.
Okay, moving to mobile. Android and the Google Play Store. Android powers, what, most smartphones globally?
Around 72% market share, it's huge. And it's open source, so Google doesn't charge for the OS itself.
So how does it contribute financially?
Its primary value is strategic. Widespread distribution, control over the mobile ecosystem. By giving it free to manufacturers, Google ensures its core services. Search, Chrome, Maps, YouTube are pre-installed on billions of devices.
Reaching users outside Apple's walled garden.
Exactly. The Play Store is where they directly monetize that user base, usually a 15–30% commission on app sales, in-app purchases.
And that platform's revenue.
Mostly Play Store. It was a significant part of that $34.7 billion from subscriptions, platforms, devices in 2023. Grew a healthy 19% year over year.
But Android's dominance has attracted regulatory heat, hasn't it? That big EU fine for bundling apps.
That's right, a multi-billion euro fine, allegedly abusing market dominance by requiring pre-installation of Search and Chrome.
Google's appealing that.
They are, arguing their practices actually fostered competition, didn't hinder it. But because of the pressure, they have made changes, like offering users in Europe a choice of default search engine.
And there are TAC costs here too, right? Deals with manufacturers?
Oh, yes. Deals with Android OEMs, mobile carriers, to ensure their services are prominent. That was nearly $15 billion in Q4 2024 alone.
So despite costs and regulatory hurdles,
Android remains incredibly valuable. Profitable, and a massive barrier to entry for competitors.
Okay, let's pivot to Google Cloud. This has been a major investment area, a strategic focus, diversifying away from just ads.
Absolutely. In 2023, Google Cloud brought in $33.1 billion revenue. That's a remarkable 26% increase from the year before.
And the big news was profitability.
Huge milestone. First full year of operating profit, $1.7 billion. Shows those massive investments in infrastructure services are finally starting to yield significant financial returns.
But it's a tough market. AWS, Microsoft Azure are the established leaders.
They are indeed. Google Cloud holds around 10–13% global market share, puts them in third place.
But growing fast.
Exceptionally strong growth recently, actually outpaced both AWS and Azure in Q4 2024, so they're rapidly gaining ground.
How are they differentiating themselves? Trying to win share.
They're leveraging Alphabet's core strengths, AI, data analytics, their advanced AI infrastructure, those custom TPUs, tensor processing units.
Optimized for machine learning.
Right. And their AI platforms like Vertex AI, the generative AI tools, those are proving to be significant differentiators. They've also been landing major enterprise clients, Ford, Deutsche Bank.
And profitability improving.
Yes, achieving greater economies of scale, optimizing costs. With a cloud market TAM estimated in the trillions, it's a massive long-term growth opportunity.
And that planned $75 billion CapEx in 2025 for AI and cloud.
Underscores its critical strategic importance. They're betting big.
Beyond these giants, there are other Google products. Maps, Chrome. They don't generate revenue directly in the same way, but they're crucial, right?
Absolutely crucial. They've enhanced the whole ecosystem, indirectly feed the core monetization. Maps is integral to local search ads. Chrome helps keep Google search the default. Drive, Gmail, they increase user stickiness.
Keep you locked into the Google world.
Pretty much. Plus, Google Assistant, Nest smart home devices. Key parts of their broader AI push in the connected home. Generally free to users, yes, but instrumental. Expanding reach, gathering data for ad targeting, creating that powerful network effect, high switching costs.
Then there's hardware, Pixel phones, Nest devices. Not huge market share, but strategically important.
Vital, strategically. Low single-digit smartphone share, yeah. But Pixel phones showcase Android's full capabilities, cater to that niche of pure Google software fans, provide valuable first-party data for AI and services.
And
Leadership in some smart home categories. Even though hardware is generally lower margin than software, it's a tactical investment, protects and extends the core software business. We've even seen hardware growth recently, record Pixel sales reported.
so looking at the financial profile across all these segments, what's the big picture?
Google services. Very high profit margins. Google Cloud, now showing strong profitability, clear growth path. Tech, significant but necessary expense. Geographically, well-diversified revenues. Fundamentally, these core businesses have incredibly durable advantages. Scale, data, tech capability.
Dominant in digital ads.
Immense share. But long-term growth hinges on sustaining that core strength and successfully scaling Google Cloud.
Sounds like an incredibly powerful engine. Okay, we've explored the core. Now let's shift to the more aspirational side. The transformative ventures, moonshots, disruptive bets. This is where Alphabet's innovative spirit really comes out, doesn't it?
Absolutely. This is where they're looking far beyond today's horizon, making those high-risk, high-reward investments, the kind that could redefine their future, maybe even whole industries.
Mostly housed within X, the Moonshot Factory, and that other bets segment.
Right. Currently contribute very little revenue, but fundamental to long-term value creation, their commitment to pushing boundaries.
We're talking Waymo, self-driving cars, intrinsic robotic software. Quantum AI sounds like sci-fi.
Let's start with Waymo, probably the most prominent, most visible of these bets. Came out of Google's original self-driving project back in 2009.
Developing fully autonomous driving tech, the Waymo driver.
They're already operating fully driverless robotaxi services, Phoenix, San Francisco, expanding to LA, Austin, other cities.
How many rides are we talking?
Recent reports suggest over 250,000 fully autonomous paid rides per week. It's scaling up.
And their tech approach. LiDAR, radar, cameras. Different from, say, Tesla's vision only.
Yes, a more sensor-rich approach, coupled with advanced AI software. They're targeting huge markets, ride-hailing, logistics, delivery, partnerships with Uber, automakers like Jaguar, Geely, Chrysler.
But still losing money.
Oh, yeah. Minimal current revenue, substantial ongoing losses, but widely seen as a leader in what could be a truly transformative industry.
And intrinsic. Robotic software, what's their angle?
Intrinsic spun out of X in 2021, focused on AI-powered software to make industrial robots way easier to use, more adaptable, cheaper to deploy.
Democratizing robotics, basically.
That's the vision. Extending robotics beyond just huge, specialized factories. Their core offering is like a robotics middleware platform, but infused with AI.
Acquisitions helping there.
Strategic ones, yeah. Open Source Robotics Corp, ROS, Vicarious for Robotics AI, plus key partnerships like with NVIDIA for generative AI and simulation for robot training, accelerating progress,
Target markets.
manufacturing, logistics, service industries, aiming to lower the barrier for robotics programming and deployment.
And quantum AI, that sounds incredibly ambitious.
It is hugely ambitious. The goal, build quantum computers far beyond classical supercomputers.
Alphabet's been a pioneer here, right? Quantum supremacy in 2019.
With their 53-qubit Sycamore chip, ongoing work now is scaling qubits, reducing those pesky error rates. They recently unveiled Willow, over 100 qubits, making progress in error correction, too.
The long-term aim.
A general-purpose, fault-tolerant quantum computer by the end of the decade, potentially millions of qubits, robust error correction. Revolutionary stuff. Drug discovery, material science, complex optimization, cryptography, still firmly R&D, no direct revenue yet, apart from some cloud simulation services via partners, but the long-term potential, trillions.
X seems like a real incubator. Wing for drone delivery, Fairly in life sciences, mineral and sustainable ag.
Exactly. Wing's already operating commercially in Australia, US, Finland. Partnerships with DoorDash, Walmart unveiled a larger drone in 2024.
Fairly.
Increasingly focused on commercializing tangible health products, raised external funding too, which signals market validation. And yeah, X has a diverse portfolio.
But not all succeed. Loon, Makani.
Right. The fail fast, learn quickly approach is fundamental to X's model.
What gives Alphabet the edge in pursuing these futuristic high-stakes ventures?
Their core strengths help. AI, massive data processing, computing infrastructure, that's often a big underlying advantage. Plus, their deep pockets. They can fund the long development cycles these complex techs need. Most startups just can't.
And more financial discipline now? Ruth Porat's influence.
Seeing more of that, yes. Applying more rigor to other bets. Some ventures, like Waymo and Verily, even seeking external funding, introduces market validation, financial accountability.
So these moonshots, low revenue today, but high potential future growth options.
Absolutely. Analysts often give them minimal current value in aggregate. So any big breakthrough, successful commercialization could lead to a substantial stock re-rating.
And innovation isn't just in X, right? It's in the core too.
Crucial point. It's continuous within Google services. Cloud. Fueled by massive R&D, spent over $45 billion in 2023 alone. And the recent merger of Google Brain and DeepMind into Google DeepMind underscores AI's central role everywhere.
So the moonshots provide long-term optionality beyond ads.
Critical optionality. And their track record, turning seemingly crazy ideas like YouTube and Android into huge successes, well, it speaks for itself.
Okay, comprehensive picture of what Alphabet is and its ambitious future plans. Now, the competitive landscape, who are they battling in this tech arena? Must be intense.
Exceptionally competitive. Intense competition with other tech giants, Apple, Microsoft, Meta, Amazon, plus growing influence from Chinese tech like Baidu, ByteDance. Alphabet's a key member of the Magnificent Seven for good reason.
Let's start with Apple, often called a complex relationship. Partner and fierce competitor.
Very accurate. iOS versus Android is the big one in mobile OS. But Google pays Apple billions to be the default search on iPhones. That's partnership.
But they compete directly elsewhere. Browsers, maps, assistants, app stores.
Safari versus Chrome, Maps versus Maps, Siri versus Assistant, App Store versus Play Store. Yep. Ongoing speculation about Apple maybe building its own search engine. That'd be a huge shift.
And Apple's privacy moves.
ATT. App tracking transparency had a notable impact on Google's ad business effectiveness. While both are in hardware, Apple dominates smartphones. It's a delicate dynamic. Google benefits hugely from being on iPhones, but has to strategically prep for maybe less presence there someday.
And Microsoft, competitor across many key areas. Search, cloud, productivity, AI.
Definitely. Microsoft has really intensified search competition with AI-powered Bing, leveraging their OpenAI partnership.
Google's responded with AI in search too.
It's a major battleground. Even small shifts in search share have huge implications. Fierce rivals in cloud too. Azure is number 2 globally, Google Cloud pushing hard for number 3.
Microsoft's enterprise advantage. Windows, Office.
Strong advantage there. Google Cloud differentiates with data analytics, AML strengths. Competition extends to AI chips, Google's TPUs versus Microsoft's Silicon projects, productivity software, Office 365 versus Google Workspace, OS browsers, Windows versus Chrome OS Android, Edge versus Chrome, and the talent war for AI researchers, engineers. Incredibly intense, especially with Microsoft's OpenAI link.
What about Meta? Facebook, Instagram, big in digital ads, but not direct competition in search or cloud.
Primary competitor for ad dollars and user attention. Meta dominates social networking. Google leads in search, YouTube video. Together, they're kind of a duopoly in online ads.
Apple's ATT changes hit Meta harder.
Arguably, yes. More impact than on Google's search-driven model. Short-form video is direct competition, though. Instagram Reels, TikTok versus YouTube Shorts.
Future battlegrounds. Metaverse, VR, AR.
Could be. Meta's Oculus versus Google's AR ambitions, their relationship is often called frenemies in ads. Collaborate sometimes on infrastructure, but fight fiercely for ad budgets, often lumped together by regulators too.
And Amazon. E-commerce, giant, but also dominant in cloud, growing fast in ads.
AWS is the undisputed cloud leader, much bigger market share than Google Cloud. Fierce competition for enterprise workloads. Amazon's ad business is growing rapidly, especially product searches. Directly challenges Google's traditional search ad dominance.
Google's response, improving Google Shopping.
Right. Increased competition for retail ad budgets. They also compete in smart home, voice assistants, Alexa Echo versus Google Assistant Nest. Both have big installed bases. Some tangential competition. Prime Video versus YouTube, Twitch versus YouTube Gaming. Amazon's also developing its own data center AI chips, competing with Google's TPUs.
Different cultures, too.
Amazon, retail plus cloud, lower margin focus historically. Google, it engineering driven. Unlikely either challenges the other's core dominance. Fundamentally, Amazon won't do general search. Google won't become a huge e-commerce retailer. But the overlap and competition keep increasing.
And the Chinese tech firms. Google's limited presence in China itself, but they're global forces now.
Right. Core services mostly blocked in mainland China, but companies like Baidu, Google of China are huge there, advancing fast in AI, potential future global competitors. ByteDance's TikTok is a global force competing directly for attention with YouTube Shorts. Tencent, Alibaba, mostly China-focused, but have big cloud platforms like AliCloud, #4 globally, growing international ambitions.
Raising the competitive bar globally.
Driving rapid innovation, yes. Raising the bar for everyone, including Google.
So, an incredibly complex, multi-front battle. How's Alphabet holding its ground, continuing to grow?
Leveraging core strengths, dominant market share, powerful brand, diversifying portfolio, massive scale and data in AI, investing heavily in R&D to keep their tech edge.
Diversification into cloud helps.
Definitely reduces reliance on just ads, and the long-term bets offer future growth avenues. Staying at the forefront of AI is absolutely crucial. Strategic partnerships matter too, even with rivals sometimes, for distribution. It's dynamic, constantly evolving. Alphabet's proven resilient, adaptable, but no room for complacency.
Okay. Operating in this intense, global competitive environment naturally leads to geopolitics and regulation. Seems like an increasingly huge factor for big tech like Alphabet.
Absolutely. Their global reach puts them right in the middle of a complex, evolving web of regulations, geopolitical pressures across countless jurisdictions. We need to consider rising scrutiny in the US and EU, their unique China situations, supply chain risks, data governance.
Let's start stateside. The US regulatory environment. Feels like antitrust scrutiny on big tech, including Google, has really ramped up.
You're absolutely right. The DOJ, state AGs, multiple significant antitrust lawsuits against Google, focusing on search dominance and their control over the ad tech ecosystem.
There was that landmark ruling, August 2024.
Federal court found Google holds a monopoly in search, now in the remedies phase. Potential outcomes: mandatory data for sharing, maybe even forced breakups, Chrome, YouTube, ad tech.
And another case on ad tech.
Yes. April 2025 ruling. Judge found Google illegally monopolized ad tech, harmed competition consumers. Potential remedies there could involve divesting parts of the ad business, DoubleClick, AdX.
So the political mood is tougher on big tech.
Clearly shifting that way. Plus new state privacy laws like California's CPRA adds complexity. Google's proactively responding too, phasing out third-party cookies with its Privacy Sandbox initiative.
And the EU. Historically even more assertive with regulating U.S. tech giants. What's the climate there?
Long active history, multiple huge fines against Google, over $8 billion total. Key cases involved Google Shopping, Android AdSense, mixed results on appeal for Google.
Another EU case ongoing on ad tech?
Yes, potential divestiture there too. Plus sweeping new EU regulations, the Digital Markets Act, DMA, Digital Services Act, DSA, effective 2022-2023.
DMA designated Google a gatekeeper.
Right. Strict new rules on fair competition, no self-preferencing, allowing third-party app stores on Android, interoperability requirements.
Google's making changes.
Announced compliance measures, rival app stores, default search choice screen on Android. The DSA imposes stricter rules on content moderation, algorithmic transparency, risk mitigation for platforms like YouTube. Non-compliance means massive fines, 6–10% of global revenue, potentially.
Will these fundamentally change things?
Will require adjustments, definitely, but unlikely to drastically shift market positions near term. Plus, GDPR on data privacy since 2018 continues to bite. Proposed privacy regulation could tighten tracking rules further.
China's fascinating. Google pulled core services years ago. Ongoing implications.
Since 2010, mostly unavailable in mainland China. Disagreements over censorship meant forfeiting the world's biggest internet market, but also avoided direct compliance with censorship, potential IP transfer demands.
That Project Dragonfly idea. Censored search.
Shelved after huge backlash. But China still impacts Alphabet via hardware supply chains, though they're actively diversifying. Trade tensions, chip export controls could affect hardware. Geopolitical conflict, like over Taiwan, could disrupt chip supplies for hardware and data centers. And Chinese tech competitors like TikTok, Huawei operating globally pose challenges.
So navigating this complex global web requires extreme caution, strategic foresight.
Absolutely. Multiple risks. Vast global data center network, reliance on international supply chains for hardware, energy. Geopolitical events like Ukraine war, sanctions have impacts. Data localization rules in places like Russia require adaptation. Constant threat of sophisticated cyber attacks, maybe state-sponsored, like the 2009 Aurora attacks from China.
So huge investment in security.
Substantial investments. Plus the global trend towards controlling data flows. EU's GDPR restricts data export. Data localization laws in India. Turkey forced operational changes. Cloud sometimes needs local data centers or partners. Policymakers worldwide are signaling closer scrutiny.
Google's defense.
Services are good, benefit consumers' businesses. Regulation harms them. But the evolving regulatory geopolitical landscape remains a primary risk. Could significantly influence long-term investment prospects. Their adaptability, complying while still growing, like in the EU, will be crucial.
All of these factors, core strength, moonshot potential, competition, geopolitics, regulation, ultimately hit the bottom line. Financial performance. How's Alphabet doing there recently?
Performance has shown remarkable resilience, strong execution, especially considering macro uncertainties and their ongoing big investments in future growth. Full year 2024, revenue hit $350 billion, healthy 14% increase year over year, 15% constant currency.
Q4 2024 was strong too.
Very robust. $96.47 billion revenue, up 12% YoY. Both Google services and cloud showed strong growth momentum.
And profitability, always a key health indicator.
Excellent. Full year 2024 operating income surged to $112.4 billion. That's up 33% from 2023. Operating margin improved to 32%, up from 27%.
Partly due to those 2023 cost controls. Layoffs.
Partly, yes. Workforce reduction of about 12,000. Q4 2024 operating margin remains strong at 32%. Google Services consistently has higher margins, around 35%. Big highlight. Google Cloud hit its first full year of operating profit in 2023, $1.7 billion, $2.1 billion just in Q4 24.
Other bets losses.
Slight narrowing trend there. Net income for 2024 reached $100.1 billion. Huge 36% increase YoY. GAAP diluted EPS, $8.04, up from $5.80. Net margin healthy, 28.6%.
Aided by other income swings, equity investment gains.
Those helped too. They also contained operating expense growth well in 2024. R&D still substantial, $45.4 billion, 15% of revenue, up about 15 strength. Still a very strong cash generator. 2023 operating cash flow, impressive $101.7 billion. CapEx increased to $32.3 billion, but free cash flow is still a robust $69 billion.
CapEx rose further in 2024, AI and cloud investments.
Primarily driven by that, yes. Balance sheet remains exceptionally strong. $113.8 billion cash, relatively low debt, $14.7 billion end of 2023. Net cash position around $99 billion.
And they started paying a dividend.
First ever, late 2023, $0.25 per share in Q4 2024. Plus continued substantial share buybacks. $62.2 billion repurchased in 2023, similar to prior years. Reduces share count, offsets stock compensation dilution.
What about current valuation? How are investors valuing the stock now?
As of early 2025, valuation multiples look quite attractive. Trailing PE around 17.5x, forward PE similar, around 17x, lower than many large-cap tech peers, broadly in line with S&P 500 average.
PEG ratio potentially below 1?
Yes.
Suggests undervaluation relative to growth.
Possibly, yes. EBITDA multiple around 12x for 2024, expected around 10x for 2025 estimates. Free cash flow yield attractive too, around 4%. Some analysts have even called Alphabet the cheapest of the Magnificent Seven.
Morningstar rating.
Favorable 5-star rating. This relatively relatively lower valuation might partly reflect those regulatory uncertainties we discussed.
Key insights from recent earnings calls. What context did management provide?
CEO Pichai consistently highlighted AI leadership driving recent strong performance. Emphasized cloud and YouTube combined hit that $110 billion annual run rate by end of 2024. Plans for that big CapEx increase, $75 billion in 2025. Strong bullish signal, especially for AI and cloud growth.
Focus on efficiency, too.
Commitment to durable efficiency in managing expenses. Reported search ad revenue reaccelerated in Q1 2025, suggests continued core strength. Interestingly, an analyst asked specifically about Waymo monetization on a recent call shows rising investor interest in those long-term bets.
Jai's response.
Hinted at future Waymo optionality. Personal vehicles, more partnerships.
So overall financial picture seems robust. Strong growth, healthy profits, big cash flow, returning capital to shareholders.
Precisely. Despite challenges, current financial performance is strong. Well-positioned for sustained double-digit revenue growth medium term. Potential for EPS growth to outpace revenue thanks to buybacks, improving leverage.
Which brings us to the bottom line. Considering everything, the analysis, the data, what's the final investment thesis?
Yeah.
The overall recommendation for Alphabet long-term.
After looking at it all, dominant core businesses, the promising innovation pipeline, their proven ability to navigate a complex global landscape, that robust financial position, the long-term investment thesis for Alphabet remains compelling. Our recommendation is a BUI.
Can you summarize the key reasons behind that BUI recommendation?
Okay. Alphabet operates right at the nexus of digital ads, cloud, AI, three massive growing sectors. Core Google businesses are cash machines with durable competitive advantages. Unmatched innovation engine. We expect continued healthy revenue growth, maybe 10-12% CAGR next 5 years. Strong, improving profitability potential for mid-30s% operating margins. Solid, double-digit EPS growth, mid-teens.
And critically, the valuation.
We believe the current market valuation doesn't fully reflect its long-term growth potential and resilience. Seems the market's applying a conglomerate or uncertainty discount. Regulatory overhang, other bets losses.
But you see those risks as manageable.
We do. Core ad franchise remains remarkably resilient. Significant potential for other bets to unlock future value.
Your valuation analysis supports this positive outlook.
Our conservative DCF analysis suggests a per-share value of $150–$165. Potential for higher and more optimistic scenarios. That's notably above current market cap. Relative metrics like PEG around or below 1.0 also suggest undervaluation versus growth. EV sales, EV bit multiples look attractive versus peers. Some of the parts, even with conservative segment values, supports the current cap, with upside potential in cloud and other bets not fully priced in.
Of course, risks exist with any investment. How are those factored in?
Carefully considered. Regulatory antitrust outcomes, tech disruption threats, intense competition, macro headwinds, ESG concerns.
Important factors.
Definitely. But we believe Alphabet's core ad business is resilient. They're actively adapting to tech shifts, especially AI and search. Waymo and other bets offer substantial future growth options. Strong market positions, scale help navigate competition. Robust financials buffer against macro downturns. Governance, the dual-class shares, is a persistent ESG factor, yes. But they've made progress on environment renewable energy for data centers. Ultimately, we believe the potential rewards outweigh these identified risks.
So, summing up, Alphabet looks like a company with very strong current performance, significant potential for future growth, value creation, even considering the challenge.
Precisely. We view Alphabet as a compelling long-term investment opportunity. For institutional investors, individuals with a long-term horizon.
And for you, our listener, I leave you with this thought. Think about the profound long-term implications of Alphabet's massive, sustained investments in AI. How might these reshape not just their business, but the entire tech landscape over the next decade, maybe beyond? What seemingly far-fetched moonshot today could become indispensable tomorrow, driven by Alphabet's relentless innovation.
Yeah, it raises an important question for your own consideration. As you maybe look deeper into the source material, what factors stand out to you as most critical in shaping Alphabet's future? What's your own informed take on that delicate balance between current dominance and those ambitious long-term bets?
We definitely encourage you to explore the research report further, formulate your own well-reasoned perspective on Alphabet's future. Thank you for joining us for this deep dive.